Good afternoon, everybody. Welcome to the Liberty Call for Wednesday, Hump Day, July 6th, 2022. It's a little dark in my office. We have, looks like a rainstorm coming across the Ponderosa out here. So apologize if I get a little bit of a glare off my glasses from the television. Anyways, so like I said, hope everybody's having a great day. If it's your first time watching, give me a big old thumbs up, a like, a subscribe, share me with some friends and family. I would greatly appreciate it because I know there's people out there who are probably a little worried about what's going on in the economy today. If you want to get in touch with me, please go to dsafinancialgroup.com. All my information is there, from booking a meeting to dropping a phone call, send me an email. And there's some pretty interesting stuff I put up there from time to time. So, all right. Well, better day in the markets, depending upon your perspective and how you're invested right now. So let's take a look and see how the major indexes did around the globe. The Dow Jones finished up in the positive, up 0.23, closed at 31,037. The S&P 500 was up 0.36, closed at 3845. NASDAQ was up 0.35%, closed at 11,361. Small caps are down a little more than 0.5%. The VIX pulled back almost 3% today. It's currently sitting at 2673. I would imagine when the volatility picks up again, we'll probably go back up over 30 sometime soon, but a little bit of a reprieve today. Canada was down 0.55. Brazil was up 0.43. Mexico was up 0.46. Moving on down or over to Western Europe, Germany was up 1.56. The UK up 1.17. France was up 2.03. Euro Stoxx was up 1.85. Netherlands was up 1.94. Spain was down slightly at down negative 0.14. Italy up 1.04. Switzerland up 1.29. Portugal up 0.08. Belgium was up 1.33. Let's move on down a little further to Eastern Europe. Both Russian indexes were down. The MOEX was down 0.21. The RTSI down 3.93. Let's move on over to the Asian markets. Japan was down 1.15. Australia down 0.52. New Zealand up 2.29. Looks like all the Chinese markets were in the red today. The Shanghai was down 1.43. The SESE component down 1.25. The China A50 down 1.73. The DJ Shanghai down 1.53. The Hang Seng down 1.22. And the Taiwan weighted came in down 2.53%. So it looks like the Asian markets were mostly in the red overnight. And the European markets, most of them up more than 1%. And then here in the U.S., looks like we're up about a third of a percent if you were to average it across the board. So all in all, not a terrible day. Again, looking at the longer term trends until we buck the downtrend we're currently in the the Dow and the S&P 500, NASDAQ. I'd expect this to go on for quite a little bit for the time being. So all righty, let's go ahead and read through today's market recap. Dow climbs as tech strength offsets rout in energy. Yeah, the energy markets are getting pummeled right now. Same with the commodities markets. A lot of that has to do with the a strengthening dollar. But again, let's see, the dollar index, wow, it's up to 106 right now. So, I mean, if we look at the dollar index going back, let's see here. Let me make that bigger so you can see it. Let's go out 5 years, and you can see back in 2020, I mean, the dollar was, around 92-ish, and it got down as low as 89 and change. But since then has been on a rally. And I think the bigger picture on why that's the case is primarily due to the fact that, the other central banks around the world, which the dollar is rated against, are just that much worse as far as money creation and being over leveraged. So we are the best of the worst when comparing to everything else. So, all right, let's go ahead and dive into this. The Dow climbed Wednesday as the recent revival in tech continued to boost stocks, even as investors digested the Federal Reserve's June meeting minutes, reaffirming the central bank's commitment to fight inflation. The Fed minutes showed members were in favor of, quote, moving to a restrictive stance of policy, and they recognized the possibility that even more restrictive stance could be appropriate if elevated inflation pressures were to persist. Tech stocks did most of the heavy lifting, picking up from where they left off a day earlier to help steady the broader market. Meta platforms Apple, Alphabet, and Amazon were in the green. Amazon said it had taken a stake in Grubhub to provide Amazon Prime subscribers with food delivery perks, including food delivery fee waivers. Uber and DoorDash fell sharply, down more than 4% and 7% respectively. For a second straight day, energy stocks were a major drag on the broader market as oil prices deepened their losses for a more than 9% slump a day earlier, pressured by concerns that a recession will severely hurt demand. Citigroup warned earlier this week that oil prices could plummet to $65 a barrel by the end of the year and fall to about $45 by the end of 2023 if the economy falls into recession. My own personal estimate on the price of oil is probably somewhere in the 60 to 80 range, based upon the expansion of the money supply over the last 2 years. And again, that's based upon averages from the previous years prior to COVID, and then think some back of the tablecloth math, napkin math, to figure out somewhere in that 60-ish, 80-ish range. I wouldn't put it above 80 by any stretch, but I would imagine that we will. Beard's a little wild today. It's not going to be back in that 30 to 40 range that we've been in for quite a long time, but we should see some relief here sooner than later. A key part of the Treasury yield curve, the 10-year yield over the 2-year yield, remained inverted, a key recession indicator. It was inverted also back in late 2019. Though steepened slightly from a day earlier, followed better than expected economic data. Services activity was better than expected in June, while job openings beat economists' estimates, pointing to a labor market that is likely running too hot, which isn't good news for bets on inflation peaking. Quote, while employment growth is slowing gradually, that slowdown is more driven by supply constraints rather than demand weakness, which creates continued upside for wages, Jeffries said in a note. In other news, Rivian Automotive said it delivered more than 4,000 vehicles in the second quarter, keeping it on track to deliver 25,000 vehicles this year, sending its shares 10% higher. All right, so kind of some good, some bad as far as news. All right, next article here. Oil inventories unexpectedly jumped by 3.8 million barrels, adding to demand fears from the API. U.S. crude inventories unexpectedly increased last week, confounding expectations for a decline and adding to the bulging weight of expectations that energy demand distraction is underway amid growing fears of a recession. WTI, the U.S. benchmark, traded at $98 per barrel following the report after settling down 97 cents a barrel at $98.53, a 12-week low. U.S. crude inventories increased by 3.8 million barrels for the week ending June 30th. That compared with a draw of 3.8 million barrels reported by the API for the previous week. Economists were expecting a decrease of about 1.1 million barrels. So these people are always terrible at their prognostications. Why not just wait until the numbers come out and then look at the actual data? It's weird. Let's see here. The API also showed that gasoline inventories fell by 1.8 million barrels last week, while distillate stocks decreased by 635,000 barrels. Bets on oil prices likely heading lower rather than higher have increased, pushing oil prices further under $100 a barrel this week, as market prices in the prospect of global recession and the likely hit to energy demand. Citigroup warned earlier this week that oil prices could plummet to $65 a barrel by the end of the year and fall to $45. Yeah, we already talked about that. The official government inventory report due Thursday is expected to show weekly U.S. crude supplies fell by about 1 million barrels last week. So that has a lot to do. Number one, the dollar, the dollar index having a stronger dollar pushes prices down on commodities, gold, silver, oil, and all the like. So that's why we're seeing a lot of price pressures there. And then also, if energy is stabilizing as far as demand, then we should also see some retracement there. So, but again, 1 week does not make a trend, so we'll see where things are going long term. All right, next article I got here: stocks bounce and bonds sold, mixed data and damp squib FOMC minutes. Newsquawk US Market Wrap. So I'm only going to read from a couple sections here. First, the FOMC minutes. The FOMC minutes revealed little new and reiterated Powell and reiterated Powell that participants judged either a 50 or 75 basis point rate hike would likely be appropriate in July. Participants agreed that the economic outlook warranted moving to a restrictive stance of policy and recognized the possibility that even more restrictive stance could be appropriate if elevated inflation pressures were to persist. But they did stress that they would take a data-dependent approach. There have been some talk of a potential 100 basis point move from the Fed going into the June meeting, but the minutes had no mention on this. On growth, they noted uncertainty was elevated over the next couple of years, and most assessed risks to the outlook for the economic growth were skewed to the downside, although there was no mention of recession within the minutes. Why would they not talk about a recession? Maybe because it's kind of a self-fulfilling prophecy when they talk about it. All right. And then the other section here I wanted to talk about was the dollar. The dollar surged Wednesday with recessionary fears, particularly out of Europe. Driving price action, U.S. yields saw a strong turnaround, more so than their European counterparts, which helped the dollar through rate differentials against the single currency. DXW saw a high of 107.27. A fresh year-to-date high was printed after the latest ISM Services PMI, which cooled from the month prior, but not as much as feared, although employment slipped into contractionary territory while new orders also declined. Nonetheless, business activity improved in June, and it was above expectations, while prices paid eased slightly. The latest minutes from the FOMC revealed little new muted market reaction and were deemed stale, but did reiterate Powell in that the move in July would likely either be 50 or 75 basis points as far as a rate increase. Participants also concurred that the economic outlook warranted moving to a restrictive stance of policy, and they recognized the possibility that even more restrictive stance could be appropriate if elevated inflation pressures were to persist. So again, that's why we're seeing what we're seeing. Whether or not this is a longer term trend that will be determined, but certainly not surprising. All right, last little bit of piece of information here. Recession is priced in, stagflation is not. The euro-dollar futures market is predicting a Fed rate cut in Q1 of 2023. We'll see if that actually happens. I.e., the market expects a return to easy money, but not because the Fed has reduced inflation, and instead due to troubling economic projections. And that's something I've said a lot, to clients over the last couple of months is that, yes, it's good that the Fed is raising rates today, but at the first sign of trouble, if they go back to their old ways of zero interest rates and buying up every toxic asset off the market, all that's going to, it'll make things feel good for a year or two. But once that, hangover wears off, we're going to be right back in the same spot we're sitting in right now, in the same spot we were sitting in the first quarter of 2020. We have to go through this market cycle to push out all the bad investment and the malinvestment in the economy. And until we do so, we're just going to be right back in the same spot, just with more inflation and more problems. All right. Let's see here. Gold ought to be a preferred stagflation asset, as demand for it is less tethered to real economic activity than virtually all other commodities. Yet gold mining stocks have taken quite a beating. GDXJ, the junior gold miners, making new 52-week lows on a day when ARK rallies 9%. So the analysis. Today's ARK action may be partially attributed to profit taking by the shorts. However, the current zeitgeist is that bad economic news equals good market news, and as an assumption that unprofitable tech names ought to rally hardest given they took the biggest beating. The assumption is bogus. When the Fed does pivot, if inflation has not yet been reined in, while the drop in Treasury yields will elevate all asset prices, consumers will not have the disposable income to spend on services offered by most big growth names. They will not be purchasing the 121,000 Tesla Model X and instead opt for the comparable Mercedes GLC at 54,000. They will trim down entertainment subscriptions like Netflix, Hulu, Roku, Disney Plus, etc., they will spend less time shopping, reducing the need for services like Square. Too much income will be required for food, gas, shelter, and clothing. I know these names do not rely on earnings and instead on, quote, total addressable market and network effects, but these metrics ultimately require ample economic activity to justify. In such an atmosphere, demand for true inflation hedge will manifest. Crypto is superior to gold at subverting authority, something I write about here. There's a link if you want to check that out. But it's no safe haven, and folks struggling financially will not be able to stomach the volatility. Crypto outflows may be another boon for gold. I'm not sure when the market will come to this realization. The prevailing assumption seems to be that the recession will cure inflation, but again, the recent euro-dollar pivot has been driven by economic output data, not inflation, which remains at 40-year highs. That said, it may take another elevated CPI print for this to set in. I took out some call options for GDXJ. Historically, July is a good month for stocks, so the timing seems hard to pass up. Then again, the Fed may, quote, break something in the meantime, so I'm maintaining majority cash. I hope the current market paradigm shifts soon. It's confusing, poor Dave. And here's Dave column. All right, so again, we're in a bit of a weird situation where the dollar's strengthening when, intuitively you would think the dollar's a mess. We got way too much debt. The country, federal government's, hanging on by a string. But, when that's the best option out there for the world, the dollar is sort of a safe haven. So for now, it looks good, which again pushes down on asset values for commodities and things that do fluctuate with a stronger dollar. So we'll see again where the trends do head and make adjustments accordingly. So hope everyone has that's everything I had for today. Hope everyone has a fantastical evening. Again, if you do need to reach me, please go to dsafinancialgroup.com. I've always got time on my calendar for someone who needs help. So don't sit around on your hands and say, I wish I should do something. I should call. Just do it. Pick up the phone, give me a call, and I'll be happy to, at least guide you in the right direction or get you to the right person who can help you out. So, all right. Well, hope everyone has a great night, and I will talk to you guys tomorrow. Bye.